Hey everyone, this is Prophet Hers. We are back again, and this time we're going to talk about it's like a run on. So, what we're doing is going from topic to topic, and today is like improper bookkeeping equals tax audit. This is something that it actually comes with the territory. So, once you don't have your bookkeeping right, and you have either your income is overstated or your expenses is understated, whatever it is, and it's understated because your income understated because you left out, or it's overstated because you made a mistake and you put your own money in and you call it income and it basically should have been equity. All these little different things causes one, either something with your taxes or audit. It's a little bit of everything. So we're gonna get started. We're a little short today, and we'll hope that more ladies come in. But to get everything started, ladies, please introduce yourselves. Go ahead, Alicia, and make sure you let them know what happened. Okay, don't be shy.
All right. Good evening, everyone. I'm Alicia Davis. I'm the owner of the Davis Financial and Associates Group, and I was also reelected yesterday to serve on the City Council in Barnwell, South Carolina. I'm the first woman to ever serve. So yeah, I am excited about continuing on that
Woo
journey. So,
woo, woo woo.
so
I
yeah,
need the bells. All right.
yes, yeah, that's me. I'm in South Carolina. I do all things related to taxes, accounting, bookkeeping, and I'm a politician. So.
There you go. Shout it out. Y'all know I'm a mess. All right, LaFisha.
Hey y'all, I'm LaFisha Cannon. I often say one half of the Cannon brand. For those that know me and my husband tend to be inseparable. But tonight I am here from the accounting side of I guess of my life. I assist tax professionals and accounting professionals with the pieces, tools. I say tools and jewels they need to grow a successful firm.
Yes. And our goal for this is to introduce you all to our workshop that we are having. And yes, we did listen to a number of you, and we have pushed this back to January. So in January, first of all, please, y'all, excuse the baby in the background. This is why we don't like doing evenings, but we don't have a choice. And in the evenings, we are home in our home offices. But nevertheless, we are planning a workshop whereas you will understand how to take bookkeeping, get it in there correctly, because you're going to have those clients that come in at the end of the year with 12 months of statements and a bunch of receipts saying they want to get their bookkeeping done. We're going to show you what you need to do, what tools you need to make sure you get that in quickly and correctly. We're going to show you how to take that, and we're going to do an S corp. Yes, we're going to actually do a S corp, and it's going to be hands on. From that S corp, you all should know that you get a K1 schedule. So when you are doing your 1040, that K1 schedule is going on there. And guess what? We are doing that 1040 with a K1 schedule, and we're gonna throw a little twist to it because then we're gonna have that person have a schedule C because they're gonna have another business also. So you are basically gonna get three in one. And to top it off, then we're gonna have our what is it, depreciation and advanced escort, where you get to go over the L, M1, and M2 schedules that most of us do not know how to do correctly. And pray that our clients are under 250 so we don't have to do it. But Nicole said, yes, you do got to do it. Get practice, learn it, and she gonna teach you that while Kiona tells you how to fix that depreciation, which in the schedule C that we're doing, we're gonna tell you all how to actually do your auto expenses correctly or your trucking. So it is gonna be a lot. We're gonna make sure that those flyers get out. If one of you ladies can just post up those flyers that are in the Facebook chat so that everyone can understand what we are going to be doing. All right. So what we're going to do, ladies, please, as we always do, go ahead and share this so you can get this out in social media land. And while they are doing that, if you are, we'd like to know where you are actually coming in from and you're watching. Let us know what state you're in. Also, let us know about your that this if I can't even get it out. If this is a replay or not. So if you're watching this at a different time and you watching us back and forth, make sure you let us know replay. And if you have any questions, please list questions now, list questions later. We will come back and answer those questions. All right, ladies, you getting everything shared out? I see a few shares coming along. All right, tax pros, I hope you all are getting your training done right now while the ladies are going ahead and sharing. You should be getting your training. You should be getting ready. And those of you that don't know any bookkeeping, you should be jumping into your bookkeeping and have some kind of understanding, because if you do business taxes, you need to understand something about bookkeeping. And for those of you that say, oh, I'm just going to grow and I'm not going to take anything, that is just not the way to do it. And if you on these, we have groups, everyone's in these groups. Go ahead, ask your questions. Don't be worried about what no one says to you. Ask your questions so you can get an understanding. But make sure after you ask your questions, you go ahead and you jump on what you need to afterwards, which is your training courses. Do your due diligence. Stop complaining about your service bureau fees when you haven't checked them. And get ready to rock and roll, because this tax season seems like it's going to be one of the worst. All right, ladies, y'all ready for some questions here?
Yes.
All right. So we're gonna talk about clients. How do you help clients understand that close enough doesn't cut it when it comes to categorizing expenses? I'm gonna say it again. How do you help clients understand that close enough doesn't cut it when categorizing expenses? And that basically means those that's just throwing stuff in, like maybe it goes here, maybe it goes there. All right, LaFisha, I'll get you on that one first.
So one of the things that I try to take the time to do when I'm, whether it's a new client or a client I've been working with for, a number of years, because, what happened yesterday may not be where they are today in business, is to discuss exactly what it is they're doing, exactly what their business operation looks like, so that I can assist them in making sure they're classifying things properly. I also make it a point to explain to them that, when they, how can I say this? When we talk about what's ordinary and necessary,
Mm-hmm.
it's going to be ordinary and necessary is driven by whatever industry that you're putting yourself into. And it not can, will have a bearing on proper classification, especially when you start identifying what's taxable, what's not, that type of thing. I give a simple example that I give to some folks, that when we're talking about ordinary necessary expenditures and their proper classifications, um, if I buy a $5,000 camera and I am an accountant, then it might not necessarily be ordinary necessary translating over to in the tax space. But if I'm a content creator, that would be perfectly normal. I also talk through the some of the what's the word I want to use, misconceptions,
Mm-hmm.
that every time you go eat, just whether you by yourself or you making up reasons to create expenses, I should say, getting creative, and then bad
Mm-hmm.
when you can't finance nothing because you don't wrote all your income off. I see it a lot with meals. I see it a lot with transportation. Well, the use of the vehicle, and I see it a lot with home expenses. So I really try to take the time to educate them on the do's and don'ts. And let me back up. My first line of defense is always to say, hey, you need not be doing this yourself if you don't understand.
Mm.
That's where I start from the rip, and explaining to them that there are certain things that you don't expect. You serve the people you serve because you know they can't do what you do.
Mm.
And so this is where we are with this. But again, we talked about it last week before. Like, you got some people that's just adamant that they got it and they're gonna be okay, or whatever the case is. But I really try to lay it out, and I'm also not the pushy person like a don't. But I do lay out, if you do this and it does this and that does this and this does this, and this is what can happen. And a lot of times that's when I find that they're more reticent to listen to what I got to say.
Okay. Okay. All right. So now, Alicia. So this one is kind of going to go hand in hand. And it's like, how can bad bookkeepers set up impact both on corporate and nonprofit reporting accuracy? So I know, let's break that down. Basically, it's saying if your setup is bad, well, how does it affect your corporation in your nonprofit reporting?
I'll just like kind of talk from the nonprofit side first because like a lot of, well, not a lot, but I guess like the nonprofits that I come in contact with, like the new clients, they have like this misconception that okay, every dollar that they actually receive, okay, it's not taxable. But in some cases, the income that they do have is taxable. It just really all depends on whether or not it's like actually like related to a particular purpose. So yes, we talk about that first because you have to make sure that you are recording items the proper way, especially for your 990 filings. If you have certain activities, you want to make sure that your income matches with your expenses for those particular activities. So you have to make sure that you are keeping track of that. And then, like on the corporate side, one thing that I see quite a bit is, we'll have corporations where they tend to like to lump their expenses all in the miscellaneous category. It's like they don't really divide those into the proper categories. And so, within their chart of accounts, they may have all these accounts, but instead of them actually putting it where it belongs, they just put it into the miscellaneous account. And so, like a lot of times, that does actually trigger an audit for them. So, that is problematic.
Okay. Now, I'm gonna even piggyback off of that too when it comes to nonprofits, because a lot of nonprofits, they don't understand that there are the three different categories they should be breaking their expenses down and their income down in. They have to know that they have G&M with general and management. You have to have your programs, and then you still, I missed one, have to have your fundraising.
Yep.
And you got to watch what you're talking about, which is more of your UBIT, which is the business income that really does not belong in there, that
Right.
you really should not have. I do have a client that went through that. I have a client now, same thing, where they're mixing another business in and not realizing that they are really messing themselves up.
Yeah.
And it's making them being triggered to file not only just a 990, but now they got to file a 990T, and now they have two tax returns.
Yeah.
So if you're in the nonprofit arena, like you have to be careful. That's one of the harder tax returns underneath construction. And that cost accounting is the non for profit. And for tax pros, don't jump into nonprofit if you don't understand, because you can really mess someone up, especially if they're getting grants, because some grants have different percentages. You have to buy one to get one, or buy one third to get one third of your money's back. So there's so much involved in it that you should watch what you're doing. All right, so I'm gonna move on. I just spoke about that because that ran hand in hand with what you were saying, Alicia. So now let's go back to Lafisha. What's one of the areas that almost always needs cleanup before the year end?
When you said an area that almost always needs cleanup, I know for some of the folks that not my regulars because they know
All right,
better.
all right. Alicia, I'm
But
coming to you with that too. Go
for the
ahead.
newbies, the parts that I always see need cleanup um, are these, and we talked about it the other week, but these expense accounts that ain't real expense accounts,
The
like
reimbursement accounts?
credit card payments and truck
Oh,
notes as expenses, things like that, and taking the time and a lot taking the time and depending on their um, tax designation. Sometimes I've had to tell some people you can't claim that. You can't, you know what I mean? You're in a corporation and you don't have the proper documents when it came to how you utilize your personal vehicle. I got to break it down to you that you're not able to claim some of this stuff. And in the instance where they did, and I'm just, well, like I said, whether it's auto payments, credit card payments, and things like that that aren't properly classified, literally taking the time to find out, what it is, because you don't own a vehicle in your name, or you got this credit card, and sometimes it's your personal credit card, sometimes it's the business credit card. But I find that I spend a fair amount of time, especially with new clients, getting them to understand the proper classification of that type of activity. And again, sometimes, you know, more often than not, they
mm,
haven't done the proper record keeping, haven't maintained proper logs, didn't maintain proper documentation to support claiming it claiming it. So I just end up with some disappointed people. But at the same time, though they're not able to claim it in the tax year that they're looking towards, we always make a plan moving forward so they can, handle those things a little better in the future and be able to claim them.
okay. All right. Can you add on to that, Alicia? Hey, Nicole.
Yeah. So I'm gonna say like I guess one of the biggest issues I have is like really like the salaries expense and contractual services and so I really don't know why that's an issue every year, especially with my new clients, but it is because they'll have there's expenses that are under contractual services where those individuals are really supposed to be actual employees. So I do see like quite a bit of that, and so we have to go back through and straighten all of that out. And then I'll have individuals who are they may have a single member LLC, but yeah, it's like they've actually put themselves on payroll. So we have to actually go back and
Ooh,
reconcile
child.
those. Yeah, we have to go back and reconcile like every single year. So yeah, I do see that quite a bit.
Yeah, that's a big one.
Yeah.
And I'm telling you, it's so, even today I got called about a client, and this client made a lot of money, and they are on payroll and they're a
Mm.
partnership, and I'm like, holy crap. And guess what? And please, CPAs, don't beat me up, but it's a CPA again that did this.
Mm.
So I keep telling people, figure out your lane. Whether you're gonna do just taxes, you're gonna do bookkeeping. Even when it comes to taxes, if you're gonna do personal taxes or business taxes, listen, you are messing with someone else's life. So if you're going to do that, get the education and training before tax season, not during,
Mhm.
before tax season. All right, Nicole, you coming in. Let's at least introduce yourself because you just came in, and I'm ready to give you a question too.
Hello, 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 guys. Please forgive me for being late. I did have a training that we was wrapping up. But I am Nicole Grogan Austin. I am an enrolled agent with IRS, and I am considered to be the corporate tax strategist. I have been in business now going on 27 years. Love what I do. It has been moments where I wanted to give up and quit, but I keep doing what I do because God instructed me to do it. So, hey, that's me in a nutshell.
All right. All right. So this one I actually hate. What happens when business owners forget to track digital payments like Zelle and Cash App throughout the year?
You said what happened when they, I'm trying. Look, I'm trying to ration out. Okay, you said what happened when they don't track it.
Yeah, when they don't track it, and all of a sudden you turn around and you see a Zelle. Well, Zelle comes in there all the time. So I'm not gonna say Zelle, but like Cash App, even any third party, because it happens even when people have Square and Stripe. They don't know that that's supposed to be tracked. And I listen. I know we on. There are sometimes when you got to just go ahead and do the net value because that's all you got is one statement, but that is not the correct way to do that. So go ahead and
So
go.
okay, so yes, what tends to happen, what I see a lot when it comes to using these third party apps is that when the money is being direct deposit deposited into your account, and when you start to look at your sales, you're picking up the net number versus picking up the gross. And
Mhm.
that is incorrect. You're supposed to be picking up what you actually charge. If you charge someone $375 to do a tax return, and they Zelle you 300, I mean not Zelle you, because Zelle you're gonna recognize it all. But if they use a third party to pay you for that, that third party is gonna automatically withhold their fee, and then you're gonna get what is called the net. That is not your gross sales, and a lot of people mess up. What I see, even in Schedule C's, I see it C corp, S corp. When they are utilizing a third party type pay network or what have you, they do tend to forget to actually pick up the gross amount that they sell. And if you go and you look at a Schedule C, 1065, 1120, 1120S, line one specifically say gross receipts or sales, not net receipts or sale. So what they end up doing is they understate their income.
Yeah. And so for those of you that don't know, when you get that 1099K, I mean, a lot of times they haven't been going hard with it because your 1099K can be off a little bit depending on timing. But that 1099K is reflective of everything that comes in. It's just it includes sales tax. So you got a little wiggle room, but you still got to be careful. So what we're telling you is the correct way to book your Stripe, your Square. It's like you set them up like it's its own separate bank, and you set up like with a clearinghouse. I use a clearinghouse account. Any of you ladies use clearinghouse account? So if it comes in there, it goes back out, and then I book the expense. I call it the clearinghouse account, so that everything goes in and out the same account. So it's just stay more in line.
It's a temporary account that you use to kind of clean up.
That's it. It comes in the stripe. I call it stripe clearinghouse, square clearinghouse, whatever it is. It's clearinghouse, and you have to make sure that people. Here's the other thing: people don't book their expenses. Make sure you book your fees because when it transfers, you're missing your fees.
That's
Um,
it. They
if
don't
you
put
do like I
those.
do, I don't get loans through the bank. I get loans through Stripe. So when you get a loan through Stripe, you got to make sure you set it up as a loan. And when your payments are coming out. So these are things that you got to make sure you take care of when you are managing another client's bookkeeping. So don't just think it's just one bank account. Don't just think they just got that credit card payment coming in, like Laficia said, and then you ain't got
Mhm.
the expense part of the credit card account. These are issues and these are red flags.
Yeah,
Definitely
and
red
another
flags.
thing also with a lot of the third party, you can pull a report. You can pull a report that's going to show you your gross. It's going to specifically say gross sales, and it's going to show you what they withheld for their merchant fees, and it's going to show you what was deposited into your bank account.
So
So we have to make sure that we're pulling these reports, and we have to make sure that even if we are dealing with clients that are using these third party systems, we need to be able to set up a dashboard for them to be able to track what they're selling, how much it was sold for.
mhm.
So yeah.
All right, Kiona, we waiting for you because I pulled some trucking questions here and I don't see you, lady. All right. I already got a few red flags already. Um, there was one question that was saying like, what this one wasn't more for tax pros. This was more for business owners. Like, what can business owners do before they give their stuff to a tax pro? Like, what ways? What can they gather together? And what can they do? Like, my first thing that I will tell them to do is get bookkeeping, connect to all your accounts. So and truthfully, have a professional handle it. But
And
that's go
one
ahead.
thing I want to say about too is that, guys, one of the things, if you're going to be in this arena doing bookkeeping, you connect the bank accounts. No system is perfect. No system is perfect. That's why you still need to get physical paper bank statement for them, because you can
Yes.
easily go into QuickBooks and see QuickBooks has transaction that start January 15th and all the way up to the end of the year. What happened to January 1st to the 15th? Something has happened to where it didn't properly download into QuickBooks. But how would
Mm-hmm.
you know that? How would you know that they had transaction prior to January 15th, especially if you haven't worked with this client before?
Mm.
Well,
So
they need
that's
to
why you still need to get those physical bank statements.
and they should be reconciling. You can't reconcile without a control document.
Go
Exactly.
further, Lafiche. I'm gonna tell you to go further. What about your beginning balances that people forget to put into QuickBooks the correct way? So they stuff will always be wrong, and then they got to turn around and force proof. How can they start that correctly for a client that never had bookkeeping, came in, and they came in today, and you got to do their books and those beginning numbers. Tell them how they really supposed to put those in.
Well, they should be whatever ending balances are for the prior year should be beginning balances for the next. And to your point, I've seen it multiple times where people they did not enter. Maybe you started your bookkeeping in the middle of it already being in session and didn't necessarily enter all your open and equity balances, or you didn't, like I said, didn't properly reflect what the year end balances were or the beginning of the year balances. I've also seen instances where they recorded assets
Mm-hmm.
at the price that they were purchased, but they were purchased 2, 3, 4 years ago without accounting for any depreciation at all. So, it's skewing what's happening on your balance sheet. And again, most of in my experiences, people don't realize that they have this problem until one of two things happen. When they're going to purchase something and somebody's asking for, trying to determine the value of the business in order to lend them money, and it's skewed, or in that same light, they're looking at your bank statements and looking at your balance sheet, and the numbers are so far east from the west, and they've got to go back and to clean that up. And then the other thing that I've seen happen with um, folks is they're not paying attention to the actual QuickBooks. It tells you how many transactions you that are unassigned,
Yeah.
and shows you the differences between the book balance and the bank balance. And you can't move. And I've had a client, bless his heart, he was putting stuff where it needed to go to clear it, and everything, all the green checks was all there, but the balances was like, I'm like, he just pointing
Yeah.
stuff wherever he wanted to go. And that type of stuff is going, it's going to murder your statements every single time. So
Mhm.
it's important that you take the time that you set it up. I'm gonna tell you the other thing that I've seen a lot of people do too. I've seen people port in transactions. Maybe you're doing you got a client that walks in today that
Mhm.
hasn't had bookkeeping all year long, and they have gone in and connected it to the bank, and you told it to go back and get it as of July 1, but then you also extracted it, and now you have duplicate activity happening in QuickBooks.
Yep.
And so all of those types of things are gonna, definitely skew what you're just gonna end up with some bad intel and
Mhm.
junk. I had an old saying, our boss, he said, "Junk in is junk out."
Mm.
If the
Yep.
information coming in ain't reliable, then the information coming out ain't gonna be reliable either.
Mm-hmm.
Okay. And Alicia, how often have you seen people put in those balances that we're talking about for a company that's been in service for a while? They put them in open equity. Please tell people that
Yeah.
where does that really go?
So instead of what in your open equity.
Yeah, instead of open equity,
Mm-hmm.
they're opening balances. You,
Oh yeah. So honestly though, like I guess like for me, so in cases like that, a lot of times we actually see that just like to me, that's whenever a person really doesn't know how to like really set up their chart of accounts. So, like because with each individual account, you should have your opening balance that actually matches to that particular account. So if you have a cash account, whatever your beginning balance was goes there and so forth. And so and I guess like really I see an issue whenever people don't really know how to use the accounting software. So again, just because you go out and you purchase a subscription to QuickBooks does not know that doesn't really mean that you actually know how to use it. I mean, anybody can go
yes.
out there and purchase the software, but again, okay, if you don't really know how to use it, then what benefit is it really going to be? But to kind of go back to your original question too, though, so I would always suggest to don't just wait until tax time and actually meet with your tax pro, because I mean, like at that point, you may have a whole lot of errors that need to be corrected. So I know like that's why with my clients, I do like to have monthly meetings, because we do reconcile. We make sure
Yes.
opening balances are right. We make sure that, every month is closed out. So I do again suggest having those monthly meetings because you can catch errors before it's too late. Because if you're waiting until tax time, then you're gonna have an issue.
Mm-hmm. All right, Nicole, because she said close out. Y'all know I'm winking it now because I don't like these questions again. But she said close out. And I know we spoke about this, but I'm going to keep speaking about it because tell people what close out is, Nicole.
Okay, so when it comes to your chart of accounts, or even when it comes to your accounts that you're utilizing in your business, you have what is called permanent accounts and you have what is called temporary accounts. Those temporary accounts have to be closed out every single month. Your temporary accounts is the profit and loss statement. That's why I go so hard about the balance sheet, because the balance sheet shows that net worth. The profit and loss statement just only show you what's going on for that month, or if you utilize for the year. But those accounts get closed out every single month, right? So when we talk about having a net profit, that net profit is closed out into what we call retained earnings. Retained earnings flows over to the balance sheet. So these temporary accounts that we're closing out is going to flow over to our net worth sheet or our balance sheet, which is our permanent accounts. These accounts are not going to change. They're permanent. They're historical. They're going to continue to have balances year after year after year after year, even if it's small. So when we talk about closeout, that's what we're speaking of. Closing out all of those temporary accounts, making sure that we have recorded or accounted for any type of adjustments that needs to be made to any account, such as depreciation. A lot of systems don't automatically calculate depreciation and automatically um, record that journal entry for you. So you got to make sure that you're going in and you're recording that journal entry, which is also part of your closeout. And then any other account that you need to adjust that may be record something maybe have been recorded incorrectly or wrong, or it should have went to another account versus this account that it's sitting in. That's the process of closing out. You want to make sure everything is clean, everything is ready to flow over. You want to make sure that you reconcile that bank balance to that book balance, because it may be a small difference, and it may be a small difference because of the timing.
Mm-hmm.
Sometimes when we make deposit into our bank accounts, the bank has already have a certain date that they cut off, recognizing any money that's coming in or anything that's going out. But in our books, we know we're gonna record it right then and there. But that transaction, even though it happened in the month of October, may not show up until the month of November. So that's why it's very important to reconcile, especially cash is the biggest account that need to be reconciled, because cash is the most abused account.
I don't even use cash. I hate when people have like cash accounts. But so you went through the closing out of the year. I'm sorry, y'all.
You're fine.
Then there are monthly close.
Hmm. And
So
monthly close are the same. It's the same process. You may not do your annual adjusted journal entries. You may not do the depreciation every month. You may
right,
wait and do it at the end of the year. But every month, because you're reconciling that cash account every month, you are doing a closeout process because you're closing out those those temporary accounts. What you got sitting on your profit and loss statement as income as of December 31st is not what's going to be sitting on your profit and loss statement come January 1st. It's not. So those accounts are closed out every single month.
okay. All right. So now we're gonna do a little different step because we going through monthly close and all those other steps. But part of bookkeeping is also paying those or calculating those estimated taxes so that clients don't end up owing at the end of the year. And what I'm talking about is I'm talking about we real and I'm not minimizing anyone's business. I'm talking about the businesses that have actual profit. They should be paying estimated taxes. And if the tax pro or who's just become a bookkeeper don't know about it, it causes it's basically a negative effect because when it gets to the end of the year, they have to pay a lump sum. Or if the prior year they end up owing and they're not paying their estimated taxes, they get penalized.
Mm-hmm.
What can you, who didn't talk lately? Alicia, I don't think you spoke. Let's talk about why the importance of estimated taxes and what do you suggest that those that are just getting into the bookkeeping arena, what they should do to help their clients.
Yeah, so as far as like the estimated tax payments again, like it's really going to be important that we are making or that our clients are making those quarterly estimated tax payments again, just like you said earlier, just to make sure that they don't have to pay like a lump sum whenever it's whenever they have to actually file their tax return. That's going to be one of the main reasons. But the other thing is, yeah, so anytime that you actually find yourself owing at least $1,000 in the IRS, they're going to penalize you, for not making those estimated tax payments. So you actually want to save yourself some money and save yourself a heartache, by actually paying those quarterly estimated tax payments. And so for me, that's why again I meet with my clients every single month, and so I do have some clients who do have to actually make those quarterly payments, and so we meet together, we calculate it, and so we make sure that those payments are submitted to make sure that they don't have those issues at the end of the year. But for me, it's all about communication and transparency with my clients. And
Good. And just to let you all know, those estimated taxes have to be paid on the federal and the state level.
yeah.
And it really is a guesstimate, but most of the time, if I'm just doing like a set rate, let me not say that because you can't do a set rate depending on the person's income. But I know who's in what area, and I have a spreadsheet that's just set up just for that, where you just got to pop in the net income so you can calculate what it is. But the whole
Mhm.
thing is to do that calculation. Now, if you
Okay.
want to ask me, do all of my clients pay it? Sometimes they don't, but I let them know, like, okay, so you understand, I gave it to you, but if you don't pay it, it's still gonna come at you at the end of the year. So, business owners, if there are any business owners watching this, if you have a profit, you better pay your estimated taxes. It is easier to pay $2,000 every 3 months than it is to come into April and have to pay $8,000. We all may be making money, but I don't like giving that money up last minute. Trust me, I'm not. I have been one of those. I will tell you straight up. I'm like, listen, I'm not paying this right now. But then you guess what? You get interest and penalty on top of that. So just know the consequences of when you what you do and when
Hmm.
you do it.
I
So
just want to add
Yeah.
one piece to that though, because we put the emphasis on the bookkeeper being able to do it. Tax professionals can assist with the same,
yes,
especially if these are clients that you're serving them. You know, if you maybe you're not providing bookkeeping services just yet, or they don't have bookkeeping services, but it doesn't negate the fact that they're still responsible for these quarterly taxes. And if you, especially if you work with them for some time, or you can offer it as an additional service to be able to assist your client with determining what their quarterly estimated tax is. So I don't want anybody to be mistaken in thinking that that's a bookkeeper's responsibility. The taxpayer got to do it regardless. So if you can find yourself in a position to be able to support them, that would be, beneficial for them because they again avoid the penalty and um, the ease of being able to pay it over time might be your introductory to providing additional service. And that also might be what pushes a client to getting into the bookkeeping space to be able to manage it on a more consistent basis.
And I just want to touch real quick on what Laficia just said. She said taxpayers, taxpayers. So if you are a business owner and you are a business owner of a C corporation, you are treated, that C corporation is treated as an individual. So yes, they are responsible for estimated taxes as well. When it comes to the S corp and partnership, the partnership and the S corp on the federal level is not responsible for estimated taxes, but the shareholders of a S corp and the partners of a partnership are responsible for the estimated taxes.
you wanna know how many people that don't know that they try to go in and they're like, I can't make my payment. I'm trying to go in and do it under my EIN number. No, you can't. Oh no, you got to pay that underneath your own personal. It flew over. It flew
Yeah.
over.
Except for a C corporation. A C
Hmm.
corporation is the only business entity that can actually make as estimated taxes because in reality, a C corp is treated the same way as an individual.
Now, what about a professional? What is that? A PC? Is that the same thing?
A professional company,
Mm-hmm.
if it's incorporated as Inc. and then form as a public company, yes,
Okay.
they're still going to be responsible for it as well. Especially if they own $500 or more, because one thing about a C corp is stand by itself. It's standalone. It has its own tax rate. The
Mm-hmm.
corporation pays the taxes. It do not flow to any other shareholders or anything like that. So
Okay. So now I'm gonna switch a little bit because when we're talking about this, another thing is you as a tax professional are working on your LLC client, and you see your LLC client making all this money, and you don't even tell them like they should go look into becoming another entity. The whole thing is if you are doing the taxes, you're not just doing tax. Well, some of you are just doing taxes to say hi, bye, see you got it, you done, sign your documentation, we're finished. If you want to keep building your company, you can let them know that okay, you had this much profit. Maybe you need to think about becoming taxes at S corp or even changing over to a C corp. The thing is, when you're not telling them not to do anything, you're hurting them. So I know business tax money is good, but you got to get that extra education to know, like, okay, you owe taxes. What's next? Like that's an additional stream of income if you learn what to do afterwards. Do you set them up on an installment agreement? Do you, if you don't know anything about business yourself, introduce them to somebody who does? Get a referral bonus. Like, hey, this client needs to be converted to something. But the thing is, for you not to do anything is hurting the client. Again, another client just like that coming in the door and been a LLC all this time. But if you got a net profit of 300,000, you should not be an LLC. Yeah, you heard me.
and you may
Profit.
not need to be an S corp either.
No, but now, ooh, I'm gonna go into that, ladies. Okay, I have this pet peeve. Call me what you want, and tell me how you feel about it. So, to be a C corp, you got to pay attention. You got to stay in compliance, and you got to do what you're supposed to do. When I got a client that can't keep it together under an LLC, it's bad enough I don't want to make them an S corp, but I don't want to make them a C corp either because they don't maintain their balances and their paperwork the way they're supposed to. Stay in compliance, knowing about your shareholders and all that. I will not put nobody in or refer them to that as a C corp because of that. I mean,
You now we're talking about, we got to think about saving money.
mm-hmm,
Each entity, it has its own regulations.
mm-hmm,
It has its own section codes. Each entity, right? The thing about a corporation, believe it or not, has more benefits and more rights than any entity that is, right? The thing about an S corp, the S corp get to share some of the same corporation benefits. Just like a C corp has to have a board of directors, a S corp has to have a board of directors. So when we speak in compliance, each one of them, yes, they have their own thing, you know. But here's the thing: whether an S corp or a C corp, they still got to file a tax return, regardless if
mm-hmm,
they make any money, regardless if they have any expenses. So at the same time, the thing about the reason why people go with S corp is because S corp is the sweet spot of a partnership and a C corporation.
mm-hmm. Now, but
You
what's the
see,
difference between the LLC tax as an S corp and a C corp tax as an S corp?
it's no difference. They both getting the same treatment as an S corp.
Except if you're making over a certain dollar amount, you pay 21%. And if you're over
Well,
that cap already, then what? Go ahead.
uh-uh. If you have a C corp that's
Mm-hmm.
being taxed as an S corp, and you
Mm-hmm.
have an LLC that's being taxed as an S corp, they're gonna fall up under S corp rules. It doesn't even matter about the 21%. That C corp, but here's the thing: if they are elected and have the election of an S corp, they're
Mm-hmm.
going to be treated as an S corp in the eyes of the IRS, regardless of if they are a corporation or if they're LLC. They have this election, and so they got to follow the same rules. Now, when you say a C corp, that's just a C corp by itself, you know, not being taxed as an S corp, is being taxed as a C corp, because in the eyes of the IRS, they want everybody to be C corps if they could. But yes, the C corp pays a flat rate of 21%. But when we look at an S corp, and you say this person then 300,000, and we look at the tax table, where's that 300,000 falling at? 9 times out of 10 is gonna fall at over 21%.
It's
21%.
over. Mm-hmm.
You see what I'm saying? So here's the thing: why am I gonna say stick to be an S corp when you're netting? And let's look at it like this: you're netting 300,000 on the S corp, which we're hoping, and we're gonna say that you're taking reasonable compensation.
Oh, my
So
car's
now,
gonna take it.
what you got going on? You have a W-2 sitting
Mm-hmm.
there. Then you have $300,000 from this S corp that's sitting there. All of that is ordinary tax. All of that is ordinary taxable income. Therefore, that rate is going to be more than 21%.
Well, what's the tax rate on ordinary income? I'll look
It
that up.
depends on
Depends on
where
where it
in the
falls.
tax bracket, on the tax
Mhm.
table where it falls, and what's the filing status and all of that good stuff. You see what I'm saying?
I hope y'all hearing these questions that I'm asking for y'all because some people don't ask, and then later on, I got somebody in my DM asking stuff, and I'm like, what? I'm like, why you didn't ask these questions earlier?
Yeah. So yeah, it's no difference if it's a C corp being taxed as an S corp or LLC being taxed as an S corp. They're going to be treated as an S corp, fall up under all the S corp guidelines and requirements.
So
But if
it's
it's
like,
a C corp by just itself as a C corp, they have that flat rate of 21%.
so then why do people do C corps and get taxed as an S corp? I gotta find out what's that benefit because
You
I mean I
because
know
some
people do it.
some people, some is no benefit. What tends to happen is that when they register with their state, whoever tell them about a C corp, all they hear is corp.
Mm.
And so they might go to their Secretary of State and register as a corporation and think that I'm automatically S corp, not knowing it's another step that they have to take.
Oh, everyone does that.
So
If I
you
could
can
tell you.
We
be.
don't even, some of them don't even know it's automatic. All they hear, like to Nicole's point, they just hear court. And it's not until you got to file that extra tax return or you get that rejection. Because I've had people, years ago that would tell me, and before I started asking for for documentation or the support, that the election was accepted. I remember I had somebody tell me they were in S corp, and I did not ask for the letter. And when we submitted
Mm.
the tax return, it kicked
Oh
back.
my God! Did you have to do it all over?
You
I
can't.
did.
Yeah.
I learned that lesson hard.
Yep.
I ain't
Is
never
that
made that mistake again.
And do you know? Even let's just say, and now this I had happened where it was accepted. It was accepted, and now it's sitting in limbo because they say for whatever reason they don't have paperwork. I don't know how stuff gets through the IRS loopholes, but and then they will sit there and say you didn't file a return.
so? What was accepted? The Form 2553 or the tax return that was filed
No,
as
I'm
an S
talking about
corp?
the tax return. So I have I have someone right now who is in limbo. I mean, I'm going to win with them. They're telling me now that they need the DCN numbers. I said I will gladly get them to you. I said, how can you accept? He's an S corp paperwork accepted on the state level. I had to go into the IRS to get it straightened out years ago. Then all of a sudden, somebody must have looked at it and put a block on it. All of the S corps were going through. Then one year it didn't go through. I'm like, what the heck? How did you let the other years go through? And now all of a sudden you're stopping the rest. And meanwhile, you already know that they can't do anything right now because they don't have the manpower to go
Yeah.
look at everything. And I'm like, listen, I'm gonna get you those DCN numbers because this is ridiculous. But just you have to know your laws. You
Yeah.
can't think that the IRS is always correct because they're not. And like right now, the footwork, I'm like, oh, this is ridiculous what you all do. And the girl was like, ma'am, she was like, I don't even know what to tell you, but just get your numbers and help your client. I was like, yeah. I said, oh, don't worry, I'm going to. But these are things that do happen, and this is just a regular tax return. So Sharon said they had a client of mine deceased and they were not. Yes,
Mm-hmm.
yes. You have to be
Well,
careful.
we also have to understand too with the IRS. IRS is using systems just like we are.
Mm-hmm.
They, like you said, they don't have the manpower to look at each and every return that come across unless that return is flagged based on the parameters that they put into a system to say, hey, let's mark every return that comes over. Let's mark the 10th return that comes over that have head of household on it.
Mm-mm.
Let's mark or let's flag the 15th return that come over with head of household, child tax credit, earned income tax credit. Right?
That's
So they
it.
have system too that they use. So, we're gonna blame it on the system. We ain't gonna even blame it on the people. Cause sometimes
I'm
them people
not.
just be coming in,
I'm
they
not
just be
doing
getting
that.
in there a week. The same week you pick up the phone to call them, they probably just been sitting down at their desk that same week. Don't know nothing.
I still be pissed because I'd be like, you all are so fast to charge somebody and do whatever to somebody, but we gotta wait damn near a year for you to fix something.
To fix it. Of
To
course.
fix it.
Yeah,
Lord. All
definitely.
right, what am I going back into here? Yep, oh my God, it's 9 o'clock. Are we moving? All right. We believe it or not, a lot of things we went through without me going through. Um, okay, so everybody tell how to avoid an audit. Like, just give your opinion on how to avoid an audit. I know we talk about certain things on a regular basis, but I'm asking the question specifically: how can a business client, we talk about business clients, avoid an audit? Alicia.
Um, I would say, make sure again, that you are, actually categorizing your transactions the right way. So
Mm-hmm.
make sure that you, well, first of all, have your chart of accounts set up the right way, and then make sure that you are correct categorizing your transactions properly. But on top of that, make sure that you are keeping, track of your source documents. So don't just rely on your bank statements. Make sure that you're keeping your receipts, and so make sure that for every transaction that you have some type of source documents. So if you went out and bought a piece of equipment, make sure that you have the receipt for that. So as long as you can actually prove whatever you have on your tax return, then you should be okay. But again, when I say prove, like make sure that you have sufficient documentation. So not just your bank statements, but okay, again, once again, your receipts to match it. So
Okay, Lafisha.
Alicia, the one statement I say to everybody: if you can't prove it, don't put it on there. That's just
Yeah.
period, point blank.
Yeah.
Regard to the conversation we had a minute ago. Sometimes you can't. You don't really control whether or not you just arrange. It's just your numbers up or your tickets up or whatever the case is. And so I encourage everybody: don't put a thing on that tax return if you can't stand by it. And when I say stand by it, don't just stand by it like I put it on my. I put I had a business meal and you put the whole business meal there. Stand by it, meaning you're within the letter of the law of what's allowable. You can buy every single client $100 watch if you want to, but the IRS says you only get $25. So when I say if you can't prove it, then don't put it. I mean, not just be able to support it with your documentation, but make sure you're operating within the letter of the law.
Yeah.
Okay, Nicole, I'm going to give you the same one, but I want to make sure you hitting tax pros that don't get documentation and they just putting figures in.
Okay, so first and foremost, I'm gonna say this. I don't think it's any way to avoid an audit. I really don't. But what I will tell you is just like what the lady spoke of. Documentation is very, 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 very important. Very important. Because again, you want to be able to back those numbers up, whatever you put on the tax return. We talk about this in the tax industry when we talk about due diligence. We talk about that ain't gonna happen to me now. It is gonna happen. Just when it's gonna happen, you don't know. That's
Mm-hmm.
the same with any taxpayer that may get pulled in for audit. Because again, there you it's okay, if they pull a couple, they recognize a pattern, then of course y'all know they go deeper, deeper, and deeper, deeper when they start to look at tax pros.
Mm-hmm.
The same thing with a taxpayer. If they look at stuff in the tax return, maybe year after year, done seen this pop up 2, 3 times as they don't pull their returns for review, then of course they start to look at them, right?
Mm-hmm.
But to but the way again that they are doing the audits, it's going you. I think you listen. You, I don't. Well, I ain't gonna say this. But I'm just saying it's gonna happen. Just be prepared.
Yeah.
Mm-hmm.
That's the best thing. That's the best way I can put it. Be prepared. Get your documents. Okay, guys. This week for the last couple of months, we've been had audit proof it. Talk about due diligence and compliance. We done had Josie get on lives and talk about due diligence and compliance, right? You got to do your due diligence and you got to be compliant. So when they do come knocking, you got it. And one thing I want to tell everyone, if you are someone that is dealing with corporate returns, your due diligence requirement do not change. It remains the same. The same way you look at your Schedule C owners should be the same way you are looking at your C Corps, your S Corps, your partnerships, your nonprofits.
Mm-hmm.
You should be asking the right questions. You should be documenting. You should be taking notes. You should be reviewing in and everything that you need to review to make sure that what you're putting on that doggone tax return is true and accurate. And you can back it up. That's the best way I can say that.
Back it up.
Back it up.
Back it up. So, do y'all understand what she's talking about with due diligence? And I can't remember if it was Alicia or Lafisha, but they had said they used to didn't get the corporate documents. That's number one when you start working with them. That first of all, you start with an intake form. All right. I don't know about no one else's, but my intake form says you're a business. I need to see your articles, your certificate, whatever you got. I also need to see your EIN.
I don't even ask them. I don't even ask them for the articles and incorporation. I go to the
Right.
Secretary of State myself.
Oh, I do
To
both.
get it.
I
Yeah.
keep one of them
Because
out and then I go
they
check it
can
to make sure it's
they
good
can
still.
they can bring me something. They
Mm-hmm.
can set this company up 2 years ago and bring me the original documents from 2 years ago, but that don't do not say they're active right now. So I go there. I don't even ask them for that anymore. I used to. I don't. I don't even ask them for that. I go straight to the Secretary website myself.
No, I get both because if I'm doing, let's just say I got to do funding later, I don't want to come back to you. So I keep everything. I
But you
get
can
that
you
EIN
can
letter.
download it once you get in there. Once you go to
All
the
I do is
Secretary of
print them.
State, you can download it straight into a file directly off the Secretary of State website.
Hmm.
Yeah. So yeah,
But
but
you
go
get
ahead.
that EIN.
Mm-hmm.
So got the EIN number, and now you asking for reporting, right? You're asking for your balance sheet. You're asking for your income statement. I pull a trial balance because these are my clients. I know people don't come in with a trial balance. You have to look at that statement. Don't just take everything for granted. We spoke about this last week. If it's income and it has a negative number, you got to ask those questions. If it's an expense and it has a credit, you got to ask those questions. Then you should spot check and say, okay, what receipts do you have? I have started now where my clients, I'm giving them, so yes, you can upload everything to QuickBooks. QuickBooks has an attachment area that you can use, and you can actually take pictures because there's a mobile app. But I also have, and when I say Google, you got to get the paid version of your Google Drive. All right, so it's protected, and you can set it up where clients can just take pictures of the receipts. A lot of people use Amazon. You know, Amazon has a download. You should get that every single month. These are things that you should do like going forward. Now I'm telling you, I wasn't getting this stuff because I'm using bank statements and I'm going about my business. But now we just came from the IRS and they said, oh no, we're gonna dig a little further now. So you've got to get your clients to start doing this on a monthly basis. If you keep a folder for every month, listen, I'm not looking at those all the time. But you better make sure you have them there for your clients. Tell your clients to put the stuff there so they have it on a regular basis. If they got assets, get proof of what their assets are. Find out what's depreciating and what's not. Find out what's 179 and when, and then they still taking other deductions. You got to look at everything. When it comes to that auto, that automobile, we already talked about that. That automobile is not always a business expense. Just because it's in your business name don't mean it's a business expense. That's another one they're getting you on. What's the difference? And another one that everyone is telling people about is hiring your kids. You do know under S corp you don't get the same rules, right? Because y'all just listen to people saying, "Yeah, hire your kids, hire your kids." Under S corp, you got to pay those taxes. Do y'all know? I'm telling you, y'all do your homework. So when you see stuff like this on a tax return or documents are coming to you, you gotta ask these questions.
And when they're hiring their kids, it's called income shifting.
Mm-hmm.
Even if you want to do more research on it, and the way it's called income shifting. So it shifts the income from the higher tax person, the person that's going to end up paying the most tax, down to someone that do not have to pay taxes.
You know what they did that for? You know who they
New
did that
income.
for?
So if you want to do more research on it, put in income shifting, and it's going to tell you all about why they say hire your children and things of that.
And be
It's just
careful.
not the hire your kids, just to have them working in the business with you.
The fake business with the fake stuff that they doing. I was like, your child. I'm like, please give me. If you come to me and say your child worked in your business, you have to give me a write up of that. I am not signing off on it. I'm not. You're not getting me in trouble. What did your child do?
It don't be a fake
They need
business. It's just be like, what? They seven. What, really? Is this what
I
we
need a
doing?
listen. I need a job description. I need an
Right.
application. Did they fill out an application? I promise y'all, when I brought my daughter worked with me one summer, and I brought her in as an employee. She had to fill out an application. She had a job description that she had to sign off on. She had to understand what she had to do, and all baby girl was doing in there was shredding papers and getting files together. But she had to understand.
Mm-hmm.
So I had all of that. I had all the information. I had her I-9. I had the W-4. I had the G-4. I had all of that information as if I was hiring someone outside of my child.
My son had a fit. I made him. I sent him the link for QuickBooks. I was like, you don't do it, you ain't getting paid. I was like, go in and do it. He was like, Mom, what is all of this? That's what you got to do when you get paid. Mommy, you can't do it for me. No, no, you do it. But what we are telling you is this is what we do because we want to make sure we don't get in trouble. So we're telling you you should follow suit. Come on, somebody tell me about that Augusta rule. Who can claim the Augusta rule with entity? And what is it really? Come on, yeah, I want to tackle it.
Listen, wasn't then on this questions or discussion that was sent over to me talking about no Augusta rule.
Listen, it is actually 9:08. We have been over on here an hour. I am just messing with these ladies. It is November and it is my month. I am a Scorpio and I am turning 56. So I am being a Peter.
Birthday, happy birthday.
Being a Peter.
Listen, but
So,
listen, we ain't going for that tonight. We look, you see how Lapisha look, at Alicia, we all sitting here like we
so we
really
ain't
gonna
talking about
discuss this? No.
I'm hanging on by the hair of my chitty chin chin.
mm-mm.
Listen,
It has been a long week for me, so yeah.
Yo, it's been a very, very long and trying week, is to be quite
Yeah.
honest.
yeah,
But
we'll pick that
ladies,
one up next time. We'll
yeah,
tackle that next time.
ladies, as always, it's a pleasure. Believe it or not, this actually makes my day. Sometimes I come on, I be like, all right, we got to get on here. But if you listen to these ladies talk, you can see that everyone is very knowledgeable. None of us act like we know it all because we don't. And we sit on here and we learn from each other also. So
Yeah.
grab somebody to hold on to just the way we do. Like now, I think we get off now. And even we pay, who can do this tax return? We was laughing because we was like, who do forensic accounting? We was like, but you notice we said we're not touching it. The
Right.
whole thing is know your lane,
Yeah.
grab a mentor, grab a friend, and keep it moving. Make the money, but get the education
To
so
make
that
the
you're not
money.
messing up no one else. All right, ladies. It
Right.
is our time, and we getting good because we finished on time. We started at 8:08, and we finishing at 9:10.
That's
Everybody
it.
have a good night. And again, we will start sharing the link. We did push the dates off so that you can go ahead and get your training with your team. And then after the new year, you got that second week of January to get on here and make sure you're doing hands-on tax return to make sure you know what you're doing when you're messing with a business tax return. So I want to be like,
And
what's
the
his name?
bookkeeping.
Oh, definitely that because we gonna be getting a lot of people that's gonna be wanting their bookkeeping done like this. They'll be like, I got all my statements. What am I supposed to do? You better be ready for them, and we're gonna tell you how to get ready for them.
Yep.
Have a good night, everybody. I'm actually gonna have a cup of coffee at 9 o'clock.
Mm.
Good night.
Hey,
Good
Joe.
night.
Look,
Oh
am I
my
waiting?
God.